Good day, ladies and gentlemen. This is Barry Norman, excuse me, that's my name, Barry Norman on behalf of USG, and welcome to our class on Forex techniques. Now, today's class is sponsored by USG, one of the leading Forex providers in Australia. They are a regulated provider approved by the Australian Securities Exchange Commission. So when you trade Forex commodities and indices, you trade with a trusted Australian broker. You know that you're safe because they're regulated by the Australian Securities Investment Commission. All funds are segregated and stored in Commonwealth Bank of Australia. You have quick deposits withdrawals within 24 or 48 hours, and up to 12 times faster execution speed. You have negative balance protection, and you also get a dedicated account manager. They offer spreads up to 500 to 1, very low spreads and low slippage. We have currencies, indices, and commodities. You can make a minimum deposit of $100, and you get support 24 hours a day. They offer many different kinds of tools to help you trade better. You can access trading central signals directly with their MT4 platform. You get Zulu Trade to get all the different signal providers, and you can choose from which ones you want to use. And lastly, you get my Forex book, my FX book, which will put you in touch with the largest Forex social trading platform. USG has been awarded the leading broker in Australia for now 3 years running. They offer many different types of services and platforms to fit your individual needs or tailor-made for what you need. Now, when you trade with USG, you'll get a leading online broker in currency and CFD trading. They are a global company with their physical headquarters in Sydney, Australia. You can trade over 60 foreign currency exchange pairs. You can trade CFDs for equities, indices, and commodities like gold, silver, and oil. And they've been operating since 2006. And in the online CFD Forex space, that is one of the oldest providers there is. And they are regulated once again by the ASIC, and you can find their license number at number 302792 if you want to check them out. Now, again, we have many different types of trading platforms, many different types of tools. Whether you want multi-terminal or use our web trader, whether you want to use our MetaTrader mobile or download the MT4 or MT5 platform, they're all available to you at no charge. You also get daily technical reviews. You get signals directly to the MT4 platform. You get online technical research, plus our Forex TV that'll keep you up to date on the markets. So remember, we also have our VIP access and our Traders Club program, and you can learn more about these by visiting our website at www.usgfx.com and slowly go through and learn about everything we offer, or set up a demo account and try trading. Right now we're offering a phenomenal webinar program. For $5,000 capital deposit, you'll get a $500 bonus program, plus you'll be elevated to our Traders Masterclass, as well as getting all of the access to our Traders Club. All of that will be provided for you for attending today's webinar. Now, today's class is being recorded. And in fact, all the classes we offer on behalf of our clients at investing.com are housed for you on the investing.com website. And you can access the website, just click under Educational Webinars and click under the button that says Webinars on Demand, and you can see copies or recorded versions of all of our previous live webinars. Now, let's get down to business here. Forex trading can be as simple or as complicated as you want to be. In the beginning, Forex trading seems like it's very simple. It seems like your only job as a trader is to pick what direction a currency pair is going to go and collect your profit. Yeah, that's what it seems like until you start losing your money. Or maybe you think of trying to find a 100% accurate Forex trading system on the internet. If it were all only that simple. Come on, guys, let's not outsmart ourselves. Let's not, not look through the woods or see the woods through the trees. We want to realize that Forex trading is making money, and making money takes work, time, and effort, and of course carries risk. And risk control is more important than any strategy, any system, or any bit of knowledge. So the first thing one has to master in Forex trading is risk management. Now, before we can talk about any advanced trading, we need to understand that controlling risk is the most important concept that a trader can master. Speculating as a trader is not gambling. And those people, those beginning traders just think, I can pick my intuition tells me the euro US dollar is going to go up. And it happens to go up. Well, that's no different than you walking by the roulette table and flipping, $100 on a 00 and it comes up. It was pure luck. Pure dumb luck is gambling. And no matter how you gamble, sooner or later you give the house back the money. The difference between investing and trading and gambling is that you use knowledge and experience and you have control over your risk. When you can reduce your risk, your profits stay in your account. So even with a game such as poker, it can be played with either the mindset of a gambler or with the mindset of a speculator, and usually with totally different outcomes. If you've ever watched the World of Poker Championships, when those guys are playing for millions of dollars, those guys not only know strategy, they're not looking for luck. They know every mathematical computation. They understand exactly what expression every one of the other people have. They can interpret the bets that are being placed, and they can read the cards and track the cards. And this is what gives them an edge. And the thing is, in Forex trading, when you can get that edge and at the same time reduce your risk or control your risk, you can end up being successful. You may not be the leader of the pack, but you can end up in that right side of the pack that are all making money. Now, Forex risk management can make the difference between your survival and sudden death with Forex trading. Risk management is a combination of multiple ideas to control your trading risk. It can be limiting your lot size, hedging, trading only during certain hours or days, or knowing when to take your losses. But the first rule in risk management is to calculate the odds of your trade being successful. And this is important. Just because a trade looks right to you, just because you've done all of the analysis and interpretation, first you have to say, okay, what are the odds that this trade will be successful? Then you have to say, okay, if it's going to be successful, how many possible points can I make? How much profit can I make? Okay. And then you have to look at, what is my risk? Where do I have to put my stop losses? Or where do I have to exit the market if the market turns against me? What are the swings of the market? When a market is very volatile, sometimes you have to put your stop loss so low that it increases your risk so high. Okay. So you have to decide whether it's worth making a trade. Will the little bit of profit be worth the risk you're taking to make that profit? And this is important because you don't want to take these little trades at high risk. So you need to understand the dynamics of the market in which you are trading and also know where the likely psychological price trigger points are, which a price chart can help you decide. Once a decision is made to take a trade, then the next important factor is in how you control or manage the risk. Remember, if you can measure the risk, you can, for the most part, manage it. So in stacking the odds in your favor, it is important to draw a line in the sand, which will cut out a point if the market trades to that level. The difference between the cutout point and where you enter the market is your risk. Psychologically, you must accept this risk up front before you even take the trade. If you can accept the potential loss, you are okay with it. So it is more important. Too many people think, I'm going to make that trade. Look at that. I can make $1,000. Shouldn't be looking at that. It should be, I can make this trade and I'm only going to risk $200. If you think about risk as opposed to profit, you'll find out you'll come out way ahead. And there are certain formulas that you should use. I use a 3-to-1 win-loss or profit-loss ratio. I need to be able to see 3 times more profit on my potential target of where I think this trade will go, then what the risk is I would have to enter to make this trade. If it doesn't reach that 3-to-1 point, my trading will say, I cannot make that trade. Okay. This is mine. You have to determine what your risk to reward ratio is. Some people use 1-to-1. That's a big guess. Some people use 2-to-1. That's not so bad. 3-to-1 is a safety factor. There's some people use 4-to-1 or 5-to-1 that makes almost impossible to find trades. Since risk is the opposite side of a coin of reward, you should draw a second line in the sand, which is where if the market trades to that point, you will move your original cutout line to secure your position. Okay. What this basically means is with every trade, you're going to enter a stop loss. A stop loss means it's a signal to the trading platform. If the asset you're looking at falls below that price when you've entered a trade, to automatically close your position because you can't afford any more losses. Now, the thing about a stop loss is you can have lots of kinds of stop losses, and you can manually move your stop loss. So if you were to enter the euro US dollar at 117 and you were hoping it went to 117.25, and you said you can only suffer a loss if it falls to 116.80, so you put your stop loss at 116.79, means that the platform's going to close out your trade at 116.79. Now, you've also looked at your target to be 17.25. Well, as that asset starts moving in your favor and moves to 17, 1701, 1702, 1703, you should be manually moving up your stop loss. So you move off that 1779 to 1780 to 1781 to 1782. So if the market reverses itself, your loss will be a lot smaller. It also means that if you start getting up to 1715 and 1716, you could move your stop loss up to your entry point at 1700. And that way, you're already 15 points in the money, but you can't lose at that point because if the market reverses itself, it'll close you out at your entry point and you'll break even. Now, when it moves up to 17, 16, 17, 18, 7, you should have a point at which you say, you know what, I'm going to close half of my trade and take the profit. Because then you've taken half of your trade, taken your profit, and all you have left riding is half of that with your stop loss already set at your entry point. So at this point, you're guaranteed profit. But this had nothing to do with your interpretation of the markets. This had to do with managing your trade. And this is what most people don't understand. It's all about managing your trade and risk management, not simply, oh, I'm going to trade the euro to go up. Another aspect of risk is determining how much trading capital you have available. And this is another big mistake traders make. Either you have the trader who says, okay, I'm going to only risk $100 per trade, or I'm going to only trade $100 per trade, and they lock themselves into it, or they say, oh, I like this trade. It's going to make me a lot of money. So instead of entering $100, I'll enter $400 because I'm sure it's going to go up and I'm going to make myself $1,200 bucks. That is the worst scenario you can possibly have. Part of your risk management is how much of your capital you're going to invest and how much of your capital do you have open in the marketplace. Like if you've opened 6 trades all at $100 and you have $1,000 account, you only have $400 left in your account. So are you going to have another open trade? Okay. These are the decisions you have to ask. You also have to say to yourself, okay, if I've had 3 bad trades, I'm going to close out all of my positions. I'm going to pack my bags, turn off my computer, and come back tomorrow. You have to know when it's time to sit out the market. Either your strategy you're using is out of date or weak, or the markets are trading in a different way than your strategy works in, and you just need to say, okay, I'm going to take a breather. I'm not going to enter more trades and keep doing this stuff. Now, there's a very well-known program called Martingale. Martingale is a strategy. Okay, I don't personally believe in Martingale one bit, but that's my own personal preference. There's lots of traders that believe in, especially anti-Martingale. And Martingale is a formula for risk trades. And it means under Martingale, each time you have a losing trade, you would double your input on the next trade and the next trade and the next trade. So eventually, your trades will be large. And when you hit a winner, it will cover all of your losses. Okay. I think it's very risky, but it's a strategy that some people believe in because it doesn't mean you have to understand what that asset's doing. It means you have to understand and follow the Martingale principles. Anti-Martingale is just about the opposite. It means every time you lose, you will cut your losses and reduce your entry in the market until the market slowly starts to move in your favor. Okay. And there are strategies for both. So this is one way to think about the markets. I'm just pointing it out to you because you'll hear the word martingales a lot when you start trading. Okay. Again, it's something personally I don't believe in, but I'm not telling you to use it or not to use it. The next important thing you have to understand is what's called leverage. Leverage is a great tool, except it can lead you to your death. Because again, leverage lets you think about huge profit. Leverage allows you to ramp up your trades. So in other words, if you have $1,000 in your account, 100 to 1 leverage will actually let you trade $100,000 worth of an asset. Well, if that asset moves 50 pips in your favor, you made $500 and you only had $1,000 in the account. That's a nice profit. But the fact is, it also magnifies your losses. Warren Buffett says leverage is an addiction, okay? Because once you've used leverage, you don't seem like you can ever walk away from it. He says it's an important tool that if you know how to use it properly and use it when it's necessary, can make you a good deal of money. But one of the benefits of trading with spot Forex markets is the availability of high leverage. The high leverage is available because the market is so liquid that it's easy to cut out of a position very quickly and therefore easier compared with most other markets. Now you have to remember, when you're trading Forex, you're trading in what's called pips, which is 4 decimals to the right. Currencies you may hear move a lot, but they don't move in money. I mean, the euro going from 117.40 to 117.42 is a huge move. But that's 4 digits over to the right. That's a big move for a day. But that is a big move over to the right. But in dollars and cents, it's not that much money. Leverage, of course, cuts 2 ways. If you are leveraged and you make a profit, your returns are magnified very quickly, but the converse, on the converse, losses will erode your account just as quickly. Now, the important thing to a beginning trader is when you understand these concepts, is to actually write them down, make your decisions, and build what's called your trading plan. Your trading plan isn't a strategy. It incorporates strategies you use, but it's your overall plan. How much you risk a trade, what days of the week you might trade, what hours a day, how many trades you might have at any given time. It will incorporate what risk management strategy you use. It will incorporate what trading strategies you use. It will incorporate everything you want to know, because then it will keep you on track. And I've been trading for 40 years, and I use a written trading plan because I'm an old-fashioned guy, and I've been writing these and photocopying them for years. Photocopying, yes, that's what I do. Okay. But when you sit down and notice all these, you actually are making then a thought-out, intelligent trade as opposed to randomly taking trades and entering the market. So a trading plan can incorporate little unimportant things. It's your approach to the markets. Like I said, your approach could be, okay, I'm only going to enter a maximum of 20 trades a week. When I reach that 20 a trade, I'm not coming back to the market to the following week. It could be after I have 4 losers, I'm going to stop and do a full evaluation of everything in my account before I open another trade. Okay. It can exist on your entry rules, your position sizing. It will incorporate where you'll put your stop loss, how you'll calculate your risk reward. It's all written on paper. Okay. Or on your computer, on an Excel spreadsheet, and you click off the boxes. That means you don't make a mistake or overlook something when you're beginning to trade. Now, remember, risk is inherent, and I will keep talking to you about risk because it is important. But also, strategies. Now, traders can strategize all they want to come up with great trading plans. But if they can't execute the plan effectively, all of their hard work as well will be thrown out of the window. A trader has many tools at their disposal in order to trade the strategy of their choosing. These tools come in ways of different orders that allow traders to enter and exit the markets at their convenience. And unfortunately, I talk to thousands of traders a week. 90% of them do not know there's all different types of orders. Okay. They know what's called, we call a margin order, which is you go into euros trading at 112.50 and you make a trade. Well, they buy at that price or they sell at the price as listed. But that's not all you have to do. Most brokers offer market orders, limit orders, take profit orders, stop loss orders, trailing stop orders. Your trading style would dictate the order type that best suits you. There are things like OCO, one cancels the other. They are so important because they can turn your trades into profit by understanding these types of orders. Do you know OCO, one cancels another? It's an amazing trading style. You can say during an economic event, you're not sure how that's going to come out, but it's either going to send a euro skyrocketing or it's going to send a euro fall. So you say, if the euro is going to go up, I want to open a trade to go up. Okay, you can't tell the system to open it when the economic data comes out, but right before that data is released, you can see where the euro is trading, set the trade to open right above your next resistance level. So if the economic data is positive, it's going to break that resistance level and the system will open a trade for you. But you could also set a sell order to sell lower because that economic data could be weak, and you could set that at when it breaks the next support level. And you set it up as what's called an OCO, one cancels the other. What it does is when that economic data comes out, and that has nothing to do with the trading platform, and that asset starts to climb and breaks that resistance level, it will generate and open that order. At the same time that it generates that buy order, it cancels your sell order. In the reverse, if the asset falls, it will generate your sell order and cancel the buy order. Isn't that interesting? Well, this makes it easier for you to take advantage of lots of styles of trading. Now, orders should be placed in according to how you're going to trade. That is, how you intend to enter and exit the market. Improper order placement can skew your entry and exit points. So we have order entries. You have market orders, limit orders, stop orders. When you understand order entries, you can use them in your trading. For instance, when a large market event is scheduled, like I just explained, you can use the OCO. Okay. Now, a market order, this is a type of order, is often the first execution order that traders come across. This is just simply clicking the buy or the sell button because it means buy me at this price or sell at this price, and that's it. Just as the name implies, this is an order that's executed at the market and is immediate. This means that you want to enter or exit the market instantly. You can use the market order to trade at the next available price. However, you might want to note that this is a fast-moving market and where price can change in seconds. The price can alter substantially between the time the order is placed and the time that the order is completed. Now, a market order is typically what we use, okay, but not a knowledgeable trader. Okay. A knowledgeable trader will use what we call a limit order. A limit order, he can set his entry price for his asset. In other words, you tell the system you want to trade that asset, but you only want to trade it at this particular price. When it touches that price, it will execute your order. It may not be instant, it may be 5 minutes later, but say, for instance, you're looking to euro US dollar and you want to buy, but you don't want to buy at the top of the market, and you go set your order up when the euro has popped up a couple pips. Well, you don't want to buy it up a couple pips because you want to wait till it peaks back down. So instead of buying at 117.25, you want to buy it at 117.22. So you set a limit order, and the system will only execute that order when they can get 117.22. Now, there's all kinds of strategies that you could do. Take the current price, figure out where your support and resistance are above and below that current price, and order a limit order on either side of those prices. When it moves up, it's going to execute that order, and you'll get in the market that way, and that'll make you good prices. So there's all kinds of strategies. But a limit order is placed when you are willing to enter a new position or exit a current position at a specific price or better. The order will only be filled if the market trades at the price or better. A limit buy order is an instruction to buy the currency pair at the market price. Once the market reaches your specified price. That price must be lower than the current market price. A limit sell order is the exact opposite. And you know what? You can set up a limit buy and a limit sell. So when the order goes up and it hits your price, it'll execute that buy. And then when the market reverses and comes back down, it'll execute your sell. In other words, you've gotten out of the market at those either ranges and you've made the profit. So limit orders are commonly used to enter markets that when you fade breakouts. You fade a breakout when you don't expect the currency price to break successfully past a resistance or support level. In other words, you expect that currency price will bounce off the resistance and go lower, or bounce off the support and go higher. And you can actually do this multiple times in a day, playing this bounce between support and resistance. So we've talked about what? Two types of orders in general, limit orders and market orders. Well, this has now changed your whole entry into the Forex market, because you thought just simply entering the Forex market meant saying, oh, look at that, the euro is going to go up and I'm going to buy the euro to go up. Well, at this point, you've made money without actually even analyzing which way the euro will possibly go. You've taken advantage of price movement by locking in specific types of trades. Now we also have sell stop orders and buy stop orders. A stop order is an order that becomes a market order only once a specified price is reached. It can be used to enter a new position or exit an existing one. A buy stop order is an instruction to buy a currency pair at the market price once the market reaches your specified price or higher. That buy price needs to be higher than the current market price. A sell stop order is an instruction to sell the currency pair at the market price once the price reaches your specific price or lower. So stop orders are commonly used to enter a market when you trade breakouts. For example, suppose you want to trade the Swiss franc, or the Swiss franc is rallying towards a resistance level. And based on your analysis, you think that if it breaks above that resistance level, it will continue to move higher. To trade this opinion, you can place a stop buy order a few pips above the resistance level so that you can trade the potential upside breakout. If the price letter reaches or surpasses your specified price, this will open your long order. Otherwise, the order will never be open. An entry stop order can also be used if you want to trade to break downside. You place a stop sell order a few pips below the support level, and if it reaches that level, it will generate your trade. If it doesn't, your trade will be forgotten about. Stop orders are used to limit your losses also. Everyone has losses from time to time, but what really affects the bottom line is the size of your losses and how you manage it. Before you enter a trade, you should already have an idea of where you want to exit your position should the market turn against you. This comes from your risk management strategy and your risk management analysis. One of the most effective ways of limiting your losses is through a predetermined stop order, which is commonly referred to as a stop loss. In other words, you're telling the platform, if that asset falls to this price, close me out immediately. But now you have to also understand a lot more, because automatically placing a stop order based on what you can afford to lose doesn't mean it's a good trade. Because if you don't analyze the swing and the volatility of the market, you can get just stopped out in the ordinary movement of price throughout the day. Because assets don't move straight up. They bounce up and down, up and down, up and down. So part of your risk management is not saying how much can I afford to lose. It's if I need to enter a trade, where do I have to put my stop loss to cover the volatility and swing of the market? If that's how you determine where you would have to put your stop loss, then you calculate the difference between where you'd have to put that stop loss and where you would enter your trade. And if you entered a trade, how much would that cost you if you had to cover that stop loss? Because just moving your stop loss to a position that covers how much you want to risk is ridiculous because you'll just end up getting stopped out of every order based on the swings in the market. Now we have one of the most interesting order entries that will help you turn bad orders or help you turn profit. And this is called what we call trailing stop orders. This is what I talked to you about earlier about moving your stop loss manually. Well, in a trailing stop order, you tell the system that you want to keep your stop loss above a certain number, but every time the asset moves up, to move up your trade, your stop loss, so many points, but keep the difference between the current price and the stop loss so many points of such a percentage. So as that asset moves up in your favor, it's continually trailing your stop loss higher and higher and higher. So what happens? You trade the euro at 117.25 to go up. You put your stop loss at 116.85. For some reason, because the markets move crazy in an instant, somebody can make some trade and push that euro to 117.92 for 1 second. Well, if you had put your take profit order at that one, at a high number, it would have closed you out. You would have booked all that profit. But also, if you would have put your trailing stop loss, as that asset soared up for that few seconds, your stop loss was moving up with it. So when that market then adjusted itself, you would have been stopped out and you would have booked, again, a lot of profit. So it's a way of telling the system to manually watch how trades move and lock you in very closely and close you out, but at the same time move your stop or your risk, continually reducing your risk. Stop orders can be used to protect profits. Once your trade becomes profitable, you may shift your stop loss order into the profitable direction so as to protect some of your profit. For a long position that has become very profitable, you may move your stop sell order from the loss to the profit zone to safeguard against any chance of realizing a loss. So, what do you do with the stop order? You buy at my stop price if the current market rises to that level. You sell at a stop price if the current market falls to that level. Simply, a stop buy order is used to buy at a price above the current market, and a sell stop order is used to sell at the price above the market. So we have all these different kinds of order entries, and even though I'm using the euro as an example, we haven't done any analysis. All of these are ways that you can trade Forex successfully, regardless of the strategy you're using. Okay, it's going to make sure if that asset moves in your favor or moves in a way that you think it will move, it will then get in the market. So why get in the market at a market price and then you're just hoping for it to move when you can have that trade to lock in when it does what you expect it to do, or exit that market when it does what you don't expect it to do. Entry orders are those to enter the market at a specified price. It's almost impossible to monitor the market every second, and this is why an entry order can be handy. If you feel the market can take a certain action, such as break through a price, that it's been touched but hasn't yet been able to break, you would want to put an entry limit order. Okay. We can also take things one step farther by setting contingent stop and limit orders to manage our trade if our entry order is triggered while away. This gives us peace of mind that we aren't floating a naked trade without managing orders attached to it. To do this, simply click on the Advanced button while placing an entry order, and the option for setting a stop and a limit order will be there added. But then we also have more orders. Okay, we have GTC, good to cancel. So if you think eventually the gold is going to soar above the 1250 level and you don't want to enter that price till it's 1250, you can set up a buy gold at 1250 and set up good to cancel. That means that order request will stay good until you physically cancel it. But if you're only concerned because you think Janet Yellen's going to say something later today that's going to send gold prices up, but you're not worried about tomorrow, you can set good for a day. That means it will only enter that trade if something happens today. And then my favorite, OCO, one cancels the other. Now this is an order entry that you have to master, but it can make you lots of profit. A GC order remains active in the market until you decide to cancel. Good to cancel. Your broker will not cancel that order at any time. Therefore, it is your responsibility to remember that you have the order schedule. Because if you schedule a good to cancel and gold goes up to 1190, say to 1249, doesn't hit 1250, and you forget all about it, and a month from now gold goes above 1250, it's going to execute that order unless you told the system to cancel that order, because it is your instruction to keep that order open. So we could hypothetically say gold at $1,500. If we see gold rally to $1,500, that would be a definite sign of something's happening. So I just want the system, whenever gold hits 1,500, to execute a buy. Okay. So you can leave it open indefinitely, and whenever that happens, you can take advantage of it. This is your own strategy. Again, good for a day, remains active in that market trading day. It will close out and stop existing at usually 5 p.m. Eastern Standard Time. So we have all these kinds of orders. It's like going to Starbucks. You have all these different kinds of lattes. Lattes with soy milk, lattes with extra shots, lattes with that, and lattes with this. You know what happens when that woman in front of you is ordering that, non-soy latte with extra foam and this and that. You feel like shooting her. But the fact is, in the marketplace, we have all of these type orders. Fish or kill orders, after-market orders, pre-market orders. And mastering and learning these is more than just trading Forex and saying that we think the euro is going to go up. So an OCO order, which, like I said, is my favorite, is a combination of two entries or stop-loss orders. The two orders with price and duration variables are placed above and below the current price. When one of the orders is executed, the other is automatically canceled. So let's say the euro is trading at 120.40. You want to either buy the euro at 120.95, which is over top of the above resistance level, in anticipation of breakout, or initiate a sell position if the price falls below 119.85. You're not sure which it's going to do, how it's going to react to the market, but on either one of these prices, you want to be in the market. So you understand if 120.95 is reached, your buy order will be triggered and your 119.85 sell order will automatically be canceled. So simple. Then you have one triggers the other. That's a great combination. That means this is one that, yes, you take care of huge volatility in the markets. So an OTO is the opposite of an OCO, as it only puts an order when the parent order is triggered. You set an OTO order when you want to set profit taking and stop losses ahead of time, even before you actually get into a trade. So for example, if the Swissy is currently trading at 120, and you believe that once it hits 121, it will reverse and head downwards, but only up to 119. In order to catch that move while you're away, you set a sell limit at 120, and at the same time place a related buy limit at 119, and just in case you place a stop order at 121. As an OTO order, both the buy limit and stop loss will only be placed if your initial order is triggered. So look at that. Aren't computers wonderful? Aren't understanding order entries wonderful? We haven't talked about strategy. We haven't talked about technical analysis. We've talked about just using types of order entries and risk management to almost trade the market. Now, there's lots of popular strategies, okay? And today, we don't really have the time to get into these, but just learning how to hedge and using a hedge completely right as well, and combining that with the right order entry can keep you safely and reduce your risk on both sides of your trades. Okay? It's a little bit complicated, but once you master hedging, okay, you don't really care what the technical analysis is. You want to set your buy level and your sell orders and take advantage of the bounces up and down while it's trading in a range. Okay. To do an advanced balancing act, you need to start at the US dollar pairs because it gets a little bit complicated. US dollar, you need to have some volatility, some movement. You also have position trading. Position trading is also a great trading strategy using various types of order entries. Okay. And then you have an overall Forex option, okay, which are all ways that you can master trading in the Forex market before you've even decided how to use technical analysis, and all of those involve RSI, stochastics, and MACDs. Okay. Then, of course, you have scalping. Scalping is making a very short-term trade with a few pips, usually using high leverage. Scalping typically is best done in conjunction with a news release or supportive technical conditions. And you can use scalping techniques with stop loss and take profits order entries, because if you expect us to take a couple pips, you just put your take profit at that, how many pips you want to get up. The minute it jumps up, and if you say you're looking to make 10 pips, but you say if it soars up to 14 pips, take my profit, okay? And you can use this with stop losses and take profits to make lots of little trades to make profit depending on how and what type of trader you want to be. Advanced Forex trading is all about seeing all of your options to make a trade. Aside from using masterful risk management and extreme caution, advanced trading can be an alternate way to make profits and control losses. Advanced trading techniques are just about using the market behavior to your advantage. Learning to use advanced techniques properly is what will give you the edge that will make you stand apart from the average trader. So thank you very much for joining us today. As I said, our class was sponsored by www.usgfx.com. Go visit them. Okay, set up a demo account and then look at all and figure out how you would place all the different types of order entries, and you'd be surprised. Okay. You can be using some of these to your advantage and just trading the channel, what I call channel trading, finding an asset that's moving in channel and trade to the top of the channel, the bottom channel. Each time it hits the top, and you tell the system every time it hits the asset, the euro hits 117.47, sell it. Every time it hits 117 whatever, buy it. And the system, you've got the system set up, and every time it goes up and down, you're buying and selling, buying and selling, buying and selling in that little straddle, and you're doing quite well. So again, thank you very much for joining us. Thank you for supporting USGFX, and thank you for being part of the investing.com family. Have a good day now.